2 Sundays ago, we woke up to DeepSeek. NASDAQ futures are down 5% because ChatGPT has been replicated for $6 million. Okay, who saw that coming? Markets are always changing. 2017 was the lowest volatility year in the S&P in 50-odd years. Why was 2017 so low volatility? The economic data was very stable, corporate profits were very stable, and there's something about these kind of feedback loops in markets where the trades themselves sometimes propel markets higher. One might say the corollary to that now is exposure to all these winning stocks, things like Nvidia and the Mag 7. The very best time to buy is when no one can.
Welcome to Global Money Talk from the floor of the New York Stock Exchange. Joining me today is Dean Curnutt, the founder and CEO of Macro Risk Advisors, a broker-dealer specializing in global market risk analysis and derivative execution for institutional investors. He is an adjunct professor of finance at St. John's University in New York. Previously, he was managing director and head of institutional equity derivative sales at Bank of America. Dean, it's great to have you here.
Glad to be here, Ty.
It's been quite a start to the year. I mean, I guess the Trump restoration has brought along a tremendous amount of volatility, perhaps even more so than people originally thought. What are you thinking here in terms of how the markets are reacting to? I mean, basically, not even 3 weeks into the new administration.
Yeah, so markets are always changing, and I'll just go back to 2017, right? So that's the year after Trump won in 2016, and the forecast then was chaos. 2017 was the lowest volatility year in the S&P in 50-odd years, and the lowest volatility year in the bond market as well in about 50 years. You got to go back to the 1960s. So that's not to say that this year is going to be really quiet. As you say, it's off to a really interesting start. Markets, as I said, are always changing, and I think the risk profile is very international in the sense of tariffs. We've seen a lot of volatility in the FX market. We have seen some of the uncertainty around AI and the DeepSeek. So just a really interesting start to the year. And I think it just demands we put our thinking caps on.
You know, I didn't remember actually the 2017. I guess as a market maker, I was really more into the day-to-day things in 2017. But why was 2017 so quiet?
Right. It's really difficult to unpack, so to speak. In fact, interestingly, today, February 5th, it's the 7-year anniversary of the implosion of this derivative on the VIX.
Oh.
So there were these two products that were basically built around the VIX that were making money all throughout 2017, selling volatility, being short volatility, which can work really well sometimes, but can sometimes really come back to bite you. And on Feb 5th, 2018, these two derivatives, one of them is called an XIV. It's a VIX leveraged inverse ETF, went down 95%. So sometimes the good times can unwind very quickly and lead to bad times. Why was 2017 so low volatility? The economic data was very stable, corporate profits were very stable, and there's something about these kind of feedback loops in markets where the trades themselves sometimes propel markets higher, and I think that was happening in the short volatility space. You know, one might say the corollary to that now is exposure to all these winning stocks, things like Nvidia and the Mag 7.
You know, can you? I mean, it's hard to do predictions, especially about the future. You know, I love that little quip, but from what you remember about 2017 and what you're seeing about 2025 today, do you sense some parallels, some things that are quite a bit different? I mean, on the political side, certainly seems that in 2017 Trump was a newbie in the White House and really relied on a lot of the old sort of GOP hands, whereas today he seems to have really come in with a plan, and sort of the only regular guy you could say is guy or gal who's there is Scott Bessent, who's Treasury Secretary, whom the market likes, who's been relatively quiet so far. So, but in terms of the markets, do you sense certain parallels, things that are, stand out to you differently from the first year of Trump's first term?
Right. So some things are similar, some things are different. The tariffs, I think, didn't start until 2018 in earnest. So he came right out of the gate and at least used it as a negotiating tactic. We'll see where all that goes. I do remember from the tariffs as well that the market's initial discomfort in 2018, which saw a couple of big S&P down days, at some point the market kind of got used to it. So we'll see what that looks like. What's different? I don't know, about $18 trillion of national debt and about 400 basis points in yield. So the interest rate structure is much higher across the yield curve. The Fed, started tightening little by little in 2018. So that made some disruption. But here we are trying to ease, but there are questions around whether that Fed easing cycle is really going to be able to get going in a way that the stock market likes. And certainly there's some uncertainty around whether the tariffs lift prices and kind of take the Fed off course. So much higher interest rates, much more national debt, a lot of, I think, focus on the Treasury market as not necessarily the diversifying vehicle that we saw it was for a long time. So I'll take you back to the GFC, obviously just a tremendous risk-off event, right? As they say, when risky assets fall, the bond market rallied incredibly during that period, and in the years after was very much supported by the Federal Reserve, which decided, hey, we've got to continue to do this thing called quantitative easing, buying the nation's bonds to suppress interest rates. It's hard to know how much that translated into higher economic growth, but the Fed bought a lot of bonds, from 2008 all the way well into 7-8 years later, well past the crisis. So we had much lower interest rates, and we had this very consistent negative correlation between the stock market and the bond market. The stock market sells off, the bond market rallies. That's a great property from a portfolio standpoint, right? Own some stocks, own some bonds. That's what we always talked about, 60-40, right? Diversification. You're not getting that same response now from the U.S. government bond market. So when the stock market sells off, it's unclear whether the bond market is going to rally, if rates are going to come down, and that's going to offset some of your stock market losses. In fact, what did we learn in 2022? It was higher yields. The Fed was tightening much more than people had anticipated. That kind of precipitated the stock market sell-off. So here you had a joint drawdown, right? Both stock market and the bond market lost you money at the same time. And with all this national debt, high interest rate expense, and I think increasing skepticism that the fiscal house can be in order. Maybe Scott Bessent is someone who could take leadership on that front, but that's also very different, is that the interaction between the stock market and the bond market just different than 2017.
I want to look at that difference a little bit, because certainly as, I suppose a relatively sophisticated individual investor, the feel, certainly in the S&P is different. It's still at 6,000, doing relatively well, all things considered, but it doesn't seem to have that energy. It seems to be jittery, a little nervous, and that may continue to carry over, even though we've had reasonable earnings season. So you've done a lot of work in terms of options and using that to sort of insure your portfolio. So it seems like this might be a good time to think about, if you've ridden up, the S&P, to these levels. If you're holding Nvidia and a lot of the Mag 7, like my elderly father-in-law, he's trading like he's 27 years old. This might be a good time to sort of use options to put up a moat, I suppose.
Yeah.
What are your thoughts on that?
Well, so you mentioned that I taught this class at my alma mater, St. John's. I haven't done that in a couple of years, but I did that for 3 or 4 years. And the way I tried to teach derivatives is through the lens of insurance. Everybody knows insurance.
Right.
Car insurance, homeowners insurance, flood insurance, life insurance. Insurance can be costly, right? The insurance companies generally do pretty well. They are not there to lose money. So the seller of insurance generally is there to make a profit and typically succeeds. Now, obviously, we have this one area called, catastrophe insurance, which is being re-underwritten, fires and just huge floods and things like that, right? There's also a market insurance, and that's really what derivatives are. They are products that you can use to insure your portfolio for a fee. Now, it's absolutely the case that you could be over-insured. We could do that in our personal lives. We could also do that in the market. So if you're buying insurance against your portfolio falling, right, there's no doubt that you can be so worried about things, always looking over your shoulder, that you're constantly buying these insurance contracts called put options, which are going to make money as let's just use the S&P 500. They're going to make money as the stock market falls. You pay an insurance premium over the course of, could be 1 month, 3 months. There's all kinds of ways to structure these, and the insurance is going to pay out if the stock market falls. So think about it from a portfolio standpoint. Let's say you're long the SPY, and you get a big drawdown. You'll lose money in that, but the insurance, the put option, is going to pay you back, right? That's the idea. It's going to neutralize your losses. Especially, it can be very effective in big drawdowns. So things like the global financial crisis, COVID, right? There was an explosion of volatility, mostly to the downside. We'll take the 2020 example. We're coming up on just about 5 years when that hit, and it hit the market with unbelievable force in terms of the drawdown that people experienced. Those folks that had used these option contracts effectively were able to neutralize a lot of those losses. The thing about risk is you kind of never see it coming, right? That's the idea in some ways. So you've got to really force yourself, one, to not overinsure, but also to try to force yourself to think about those situations that are very unwelcome. So look at the last 2 weeks. Sunday, 2 Sundays ago, we woke up to DeepSeek, and the NASDAQ futures are down 5% because ChatGPT has been replicated for $6 million. Like, okay, who saw that coming, right? That's you talked about what's driving the S&P. The Mag 7 is a big force, right, driving the tech-heavy triple Q and S&P. So that came out of nowhere. And then, of course, this Sunday we had the tariffs. So these are two very unique sources of risk that, they're not generated by corporate America. They're not monetary policy decisions. They're really unique forms of risk. So we just have to respect that these things can come out of nowhere. And I do think that really taking a look at your portfolio and thinking about those things that can be disruptive after an incredible run. I just was looking at the triple Qs up basically 100% in 2 years. And so perhaps spending some money on these insurance contracts, these put options, is just a worthwhile thing for investors to look at.
So let's dive a little bit into this insurance, because as an options trader, you can buy it. You can sort of tailor the insurance exactly to what you want. You can make it 2 months or 6 months or 1 year. You can sort of buy insurance that those put options struck at different areas. What is for a sophisticated retail investor who has quite a lot to protect? How should they be thinking about where to buy the insurance? Is it a strike that's 10% away from the market? How long should they do it? I mean, there are even daily options, which I think are, might be, you want to be very, very careful about. But how should the investor be thinking about this?
Right. Well, just on the daily option side, that's a big innovation. It's several years old. It's very popular. It's probably consistent with our quick hit dopamine rush of trading and sports betting and so forth, and reading Twitter and so forth. Imagine if you had to roll over your car insurance every day. No one would do that, right? And that's kind of what people are doing they call it zero DTE, 0 days to expiration options. So they might serve some purpose, but I think where you're going is a little bit more of a insurance contract that's got some life to it.
Right.
The first question to ask yourself, Ty, is what does my portfolio look like, right? So if I'm long some small cap, very micro cap stocks or some biotech stocks that have very little to do with the broader market, we'll call that idiosyncratic risk, right? So if you're going to hedge, you probably have to hedge in the stock itself. And then you've got to take a very good look at what the options market can afford you. Some options are liquid, some are not. And so sometimes if you're in something that's very illiquid and the options are very illiquid, the liquidity profile is just not enough to service you. Now, if you're in things like your father-in-law, and you've ridden up NVIDIA and it's kind of a Mag 7 type portfolio, what do we know, right? Those stocks have done so well that both the S&P and the triple Q are as concentrated at the top as they've ever been. So those 7 stocks, I think, are about 30% of the S&P, 50% roughly, maybe a little bit less, of the triple Q. very tech heavy, obviously, as well. So if that's the profile of your portfolio, then these two indices are good places to start in terms of choosing the underlying that you're insuring. Okay, and those are liquid as all heck, right? So you could trade those electronically. The bid offers are very, very tight, and as you suggested, you have a menu. I wouldn't do 1 day, but you could certainly do 1 month, 2 month, 3 month, and so that's your expiration question. And then the next question you alluded to is, where do you put the insurance? There's all kinds of ways to do this, and my analogy is car insurance, right? So Geico comes to you and says, okay, we got a couple things here. Do you want we'll insure basically every scratch on the car, anything that happens to it, or do you want it's $500 a year and only if the car just disappears or gets completely totaled, we'll pay you something back for it, right? Obviously, the latter costs a lot less than the first one. And that's basically the same thing you can do with options contracts. Are you trying to insure your first 5% of loss? Are you trying to insure a loss that starts only after the portfolio's down 10% or more? So we call that the strike price is far out of the money. That's going to cost you less, right? Because if the portfolio loses 10%, you get nothing. But if it loses more than 10%, that's where it starts to pay you back. So think about that as almost like your deductible, right? That's where you're striking it. There's all kinds of ways to do it. For me, I'm in the keep it simple, stupid camp where I recommend people stay with liquid things that you can see on a screen. The great thing about the listed options market, a couple things. One is they really trade like stocks. They clear like stock. They're going to sit in your Schwab account like a stock. You could trade it electronically. The trading technology is fantastic. So the liquidity is amazing. So I think that's great. You want something that you can kind of feel and touch right next to your regular portfolio. I think that's important. And again, keeping it simple, I think something where it's 2 to 3 months in expiration, and maybe the first 5% loss you don't care about. I mean, the market's going to wiggle like that, right? So I like buying something that's 5% out of the money. So that's where the insurance starts. And then I do think it's important, back to my comment, you can over-insure. These things are not free. So if you keep buying just the 5% out of the money insurance every 2 months and rolling it over, by the end of the year, if nothing happens, great, the stock market went up, but you would have footed the bill on more than you wanted to from an insurance standpoint.
Right.
And so what I like to do is buy the 5% and then maybe sell something against it that's 15% further down. So down 5% and then down altogether 20%. Now, if we get a true meltdown where the market goes down 40%, I've only hedged 15%. It started down 5 and it lasted to down 20, so that's 15. But by selling the second put, that's the put spread, creating what's called a put spread, I'm just saving a lot of premium.
Okay.
And so I personally just don't see a cataclysmic GFC type meltdown or a COVID type meltdown coming. Those are really rare, right? Could happen, but it's really rare. And I think economizing on the premium is just an important part of the discipline of hedging.
And I know I'm trying to make this a little simple, but let's say I had $1 million portfolio, right? And let's just assume for simplicity's sake, it's just I'm just long the S&P 500 ETF, the SPYs. What percentage of my portfolio should I allocate to buying insurance on on an annual basis?
Yeah,
roughly?
I think it's everyone's different, right? Mm-hmm. Everyone's risk return objectives are unique to them. That could be for an individual, it could be for an institution. As you mentioned in the intro, my clients are institutions, and some have investment mandates that allow their portfolio to experience considerably more volatility than others. Others, their investor clients are saying, listen, I'm trying to make 10 or 12% a year. If the S&P goes up 25%, as it did last year, and you're only up 12, I'm not going to be frustrated. But if the S&P falls 25% and you fall 25%, that's a problem. So they're tighter in terms of their risk controls. I've seen investors allocate a quote hedging budget anywhere from 1% to 4% of their AUM, really. And so again, take a year like last year. In some ways, it's easy to look back and think about it. from a great year in the S&P like last year, where 25% the S&P was up, and you allocated 250 basis points, 2.5% of that to hedging, which of course, because the market went up, the hedges didn't matter. They didn't pay off. Maybe 1 or 2 days they did something. So instead of making 25, you made 22.5. Is that terrible? That still feels like a good year, right? It's a hard question to answer, but that's some range, is kind of 1% up on the high end up to 4%.
So I guess one thing about these options and this insurance, and I think it's a great analogy, is it differs from your car insurance or home insurance. Is it actually can increase in value if the market goes down in our case. So it can increase in value a lot if it goes down a lot and very, very quickly.
Yes.
And you can actually sell that insurance back out.
Yes.
So do you? Let's say we have you bought 2 month insurance or 6 month insurance. You get a dramatic move down. Do you usually counsel clients to consider taking profit on that insurance, that we've had the ugly move, and the insurance that maybe you paid 1% for could be worth 3% of your AUM? Would you counsel them to take some profit on that because you've had the move, and eventually if you don't use it, the insurance, especially if the market moves back up, will expire, will decay and expire? Do you counsel that they would, in some instances, take profit on that insurance, sell that back out?
Yeah, so you make a great point about the mark-to-market profile, what they call the mark-to-market profile of these options, which is each day they're gaining and losing value. And some of, as a person steeped in derivatives, there's some complex drivers there, one of which is the level of the market. If the market falls, the put option goes up, but also the volatility, right? So when markets fall, they tend to become more volatile, and the folks that trade derivatives recognize that, and so the value of these insurance contracts, the put options, are going to go up not only because the market fell, but because the market's assigning more volatility to the option. That's very different than, if I own car insurance and drivers get more risky, I can't go to Geico and say, hey, bid me on my car insurance contract, right? But it's very much like that in derivatives, and to your point, that's exactly what they're supposed to do. So your portfolio loses money, the put options gain value, perhaps a tremendous amount of value. And so they're doing a couple things. One is they're neutralizing those losses, and they're giving you the chance. And one of the sort of paradoxes in markets is that the very best time to buy is when no one can. Think about the epic buying opportunity that was early 2009, right? The market is on its back, and people feel like it's just going to continue. And the reason it's on its back is because no one has any capital to deploy to the market. And so the government comes in with QE and all these rescue facilities and basically says to the market, we'll give you the capital. The put option is going to allow you to be a more empowered buyer in very stressed markets, and those can be very opportunistic. I just was kind of looking at when markets sell off dramatically, what is the forward return profile? And it turns out, that in 2009 and in 2020, the forward return, as bad as things looked in the moment, the forward return out a year was just incredible. Some of it is because the market can kind of cure itself. They say the cure for low prices is low prices. Right. People kind of come in. The other thing is the government gets involved. Whether, again, it's the Fed, it's the Treasury, tax cuts and rebates, the Paycheck Protection Plan. And so that's the way I think about put options. And you made another really important point, which is at some point, these put options could become so valuable that you have no choice but to very much think about selling them, because the bid to those options is not going to remain there forever. And what happens is, as the market corrects, it'll go back up, but also the vol side, the implied volatility that is a big part of the value of the option, that's going to come back down because people are less fearful. So yeah, you do have to monetize. That's an important part of option trading.
You make a really good point, actually, when you say you can, with listed options, you can see them in your Schwab account, just like a stock, and see their value, and the investor should keep an eye on that because when that insurance increases dramatically in value, and perhaps the worst has just passed, think of it as a stock that you could sell this and buy more of what you already had or some other things. And I recall that very well. The low in the S&P, I think, was 666.
Yes.
And it's 6,000 now in the space of 16, 17 years. It's gone up nearly 10 times. So it was a great chance to deploy cash. And Warren Buffett, I think, has done that better than anybody else. He has so much cash that when there's blood in the streets, Warren's out there buying, and usually something that gives him 11% returns, and he can turn them into equity, and he's a genius at doing that. But on that point, I wanted to ask you. There's a question of if the market market had a great year last year. We don't know where it's going to be, but how much money should an investor keep in cash for the opportunities that come when there is a big drop in something, when there's it drops 10% or some small cataclysm, and you want to have some dry powder. But how much cash should you keep on hand, and with the mindset that the cash you keep on hand isn't working for you right now. Although with interest rates where they are, they're working a little bit more than they used to. So how much cash?
Well, you mentioned Warren Buffett. I mean, I think his T-bill hoard is $500 billion, which is just incredible. A couple things, right? The option value of cash. Sit there, it's not volatile, and you're basically paid to wait. So how do we think about the option value of cash? I'd say there's two things. One is, does cash pay you something? And for years and years and years, it paid you nothing. Very frustrating. Now it pays you 4-5%, right? It really depends. But even for risk-free securities, and I don't even mean 10-year notes, I mean 2-year notes at 4.3-ish%. Boy, that's pretty interesting, at least to me personally. It's not as if inflation is 8%. Inflation's 2.5%. So you do have a real yield there for sitting there. I think that's valuable. The other way to think about the option value of cash is, what is the volatility profile of the market? So when the volatility of the market suddenly shoots higher, the way I frame it is, your portfolio just got bigger. And you didn't want it to. You didn't buy a single security, but your riskiness just got higher. So for, we mentioned that period in 2017, the S&P, I mean, it was moving 20, 30 basis points a day. So if you think about you're trying to make a certain amount, boy, you've got to own an awful lot to just achieve a return or a certain risk profile. If suddenly the S&P is realizing 25 volatility, which it did in 2022, you need much less. If your idea is, I don't want to lose more than X per day, that's a function of the volatility of the market, right? And so again, when the vol of the market goes up, the option value of cash, to me, goes up a lot as well. To answer your question directly, I just don't think it's not simple, right? It really depends on how folks, number one, think about their overall portfolio. What's the riskiness of the overall portfolio? What are you trying to achieve? Are you willing to accept a big giant drawdown, and ride it out? How long term are you? I think those are, very important considerations. But I happen to think that at 4.3% on a 2-year note, the option value of cash is interesting. And here's another point I would make is, I talked about the diversification of the bond market, the idea that it'll rally when the stock market sells off, and that hasn't really been a thing. I think that's more of the 10-year part of the yield curve, 10 and 30s, and I think that's a comment about folks are worried that we just ran a 6.5% deficit with a 4.3% unemployment rate. It makes no sense. So the U.S. has got to right-size its fiscal trajectory, and I think the 10 and 30-year part of the bond market are worried about that not happening. The 2-year part of the bond market, that's a little different. That's shorter term. There's not a lot that can go wrong there. And I would say that if you show me something that's just out of left field, and we are seeing some tape bombs, as they call them, things are happening where there's some growth shock or geopolitical event, something really bad happens to the stock market. Remember, the Fed's easing cycle right now is a modest one. I think there's 2 cuts priced in. If suddenly 5 more cuts get priced in because the economy hit a brick wall, that 2-year note is going to rally quite a bit, right? That's what that is. That's sort of pricing in forward rate cuts. So I like it for a couple of reasons in that context.
Right. That's a very good point because, I think it's hard to think it's going to be less than 2 cuts, and what is it going to go to 0? But if something happens, it could be 4. I could see 3-4 cuts relatively easily. And if you hold the Treasury, that Treasury will rally that bond. I've actually been holding some cash in in my Schwab account in the Schwab Money Market Fund, which is wonderful in a way that it basically pays the 2-year note.
Exactly.
And has amazing liquidity. You can just it's like a checking account, and I can sell that and go buy something else. And I guess Schwab, because they're not a bank specifically, and you're not FDIC insured, they're happy to be able to fund at the Treasury rate. You get the Treasury rate, they're happy to fund there, so it works for everybody. Yeah. But if rates go down, that asset doesn't rally. So that's a very good point. That's a very good point. One thing we talked about just before the show, and I want to touch base on it, is gold. I think you called it the barbarous relic.
Yeah.
Can we get actually graphic number 1, up on the screen? And you've done some work. I think you were talking about how gold has been really pretty amazing in terms of how well it's done when other assets, are falling.
Yes.
So do you want to give us some thoughts?
So the barbarous relic is John Maynard Keynes.
Right.
It was 100 years ago, actually. It was 1924.
Wow.
And he was talking about the gold standard is a barbarous relic. But people call gold a barbarous relic. And I'm not a gold bug. I'm not someone predicting hyperinflation. I think it's got these interesting properties. And as you alluded to me, you can learn a lot about an asset by just looking at how it does in either different periods or even on specific days for the S&P. So, for example, in evaluating a strategy, first thing I'm going to ask you is, how did it do in October and November of 2008? How did it do during the Eurozone sovereign debt crisis in 2011? How did it do during COVID? Because you get a sense as to whether it's kind of long or short liquidity. Mm-hmm. Is it hedging, or is it taking risk where it's going to have to run away very fast and lose a lot of money quickly during a deleveraging or de-risking event? So my little test is to look at the worst days in the S&P, and I want to see how gold or other assets did on those worst days. So one subset is just since 2017, give me the 4% down days, the 3% down days in the S&P. Any day that's more than 3%. So of course we had a flurry of them in COVID. We've had a couple in 2022 as well. That XIV event that I mentioned in Feb 18. And so what's the average return of gold on those days? And it's down something like 70 basis points.
Right.
That is, to me, a great sign. It's uncorrelation at the most important time. That's a property that I want in an asset. Now, that's not to say that there aren't bad S&P days that could be terrible for gold. The true deleveraging of COVID, which was the most intense part, was the second week of March of 2020. Gold got smoked.
Right.
Everything got smoked. Even the U.S. bond market. Everything was falling because people needed cash. Anything that was worth anything, sell it. I don't even need a bond. I need actual dollars. And there are days when the S&P does fine and gold loses money. Right. So I'm not suggesting this is a hedge. I am saying that in an environment where the indices are so top heavy, we could argue, and I'm not an AI expert, it does seem to be revolutionary, but it's also priced as revolutionary.
Yes.
People are paying a pretty penny in terms of multiples and so forth. That Mag 7 is driven the S&P. You need something in your portfolio that's a non-correlated asset. And I think gold satisfies that, so it's easy to cheer for a winner. It's obviously doing quite well last year and so far this year. And then again, I think it occupies a special, what I would just call psychological place in people's minds, which is U.S. government irresponsibility. It's a treasury auction that doesn't go well. The U.S. government constantly auctioning. It needs to auction to pay interest. It's kind of the ultimate Ponzi scheme, right?
Right.
I'm only borrowing to pay the interest. That's what we do in size. And these auctions are global, they're well sponsored by all kinds of institutions, but there's a lot at stake there for those auctions to go well. And I think that in an era where I think more people are questioning the U.S. government's ability and willingness to right-size itself fiscally, gold has got a place in the portfolio.
Yeah, it's having been a gold trader for some time, it's been a remarkable run, and we're seeing historic highs now. Over the last couple of days, a lot of it has been central bank buying. It's been pretty consistent. But as you make a great point, I mean, we've got $1 trillion in interest that we have to fund. So I think my view on gold is, be flat or be long, but you can't be short this. You can't be short that commodity. Another commodity that I think we were talking about that's a little bit different than gold is Bitcoin, and Bitcoin almost seems to be like a risk asset on steroids.
Yes.
And it trades 24/7.
Yes, it's so interesting, right? Because what did you check on Sunday morning to see how the tariffs were going?
Right.
So I saw Bitcoin down 5%, and in my little mental model, I said, okay, S&P's probably down 2%. That was a pretty good guess. Right, it's an S&P futures before the S&P futures start trading. Now I'm saying that loosely. There are definitely gigantic down days in Bitcoin that have nothing to do with the S&P, and vice versa. It also is relatively less. It's less correlated to the S&P than a stock is, but it's much more of a risk asset than gold is. It's a mini gold. It shares a property that I really like, which is, I just call it optionality. Bitcoin can rally in a way that it gets stronger on the way up. When the S&P rallies, it's going to add 1%, right? Maybe post-Trump you add 2% just for one day. But the S&P is what they call escalator up, so slow up, and then elevator down, just straight down. Bitcoin can go both sides, right? It can really rally outrageously. I'm not a crypto native. I'm not a hodler, as they say. I think the cheerleading is a little unbecoming.
Right.
But I do think, 1% in the portfolio, something that you can kind of tuck away. I'm an options person, so they launched options on IBIT, which is the Bitcoin ETF. They're incredibly liquid. What do I love about them? They allow you to get involved in this asset class in a way that's suitable to your own risk-reward objectives. So maybe you don't want to just own the ETF because you've seen the ETF can go down 4 to 8% in one day. That might be too scary for you. So you can use these options. It's not a free lunch. It's not a magic money tree, but you can use the options to kind of fine-tune how much risk you want to take. There's ways to, create some downside protection, maybe sell off some of the upside gains. Some people, like Michael Saylor, would never do that.
Right.
But there's interesting trades you can do that I think they just pave the way for more people to get involved.
What's interesting about Bitcoin is that generally for equities, as the equities rally, the volatility, the insurance costs a little bit less. In Bitcoin, it's almost if Bitcoin rallies dramatically, volatility goes up. So the value of that insurance goes up. So there's a lot more sort of things you can do in the Bitcoin options market, but certainly not for the faint of heart.
Right.
I think because that thing moves around so much, and as you said, if you're a long-term holder, you would never sell a call, but there's probably a fair amount of money, to be made in sort of selling calls. For part of your portfolio over time, what volatility that's much higher than what you would find certainly recently in equity markets.
Yeah, and one of the things that's happened in the last, I'd say, 3 to 5 years, it's really started to increase, is derivatives-based ETFs. So something like IBIT, the Bitcoin ETF, there are derivatives ETFs. Simplify Asset Managers is one of them, where they're doing something very basic. It's exactly what you said. They own the underlying IBIT, and they sell an out-of-the-money call. So a couple things happen there, right? If IBIT just rockets higher, that call option is going to limit your gains, right? You'll have an opportunity cost. You wouldn't have enjoyed all the upside, but you get paid handsomely for that call option because there's a lot of volatility priced into the upside. So you're essentially converting an asset that's got no yield to something, I put yield in quotes in the sense that the call options are paying you premium, which you can bank. So if Bitcoin is, range bound to going up slightly, this could be a really interesting way of approaching the asset.
And before we wrap up, I know you've done some really remarkable work on correlations. And if we just get graphic 2 up, I remember we were looking at a chart that was really quite fascinating. Tell us a little bit about this S&P 1-year realized correlation. Looks like it's very high, and then it's dropped down very low.
Yeah, if we took that chart back another 10 years, we would see, unsurprisingly, sky-high correlations in 2008 into 2009. The stock market was not about differentiating between Pfizer and JP Morgan and Exxon. The banks were potentially taking the entire economy down, and so the market of stocks was really just a single unit, and that's what high correlation is. It's when all the stocks have a lot of co-movement, they move together, and that happens during a crisis. We saw that in COVID quite a bit as well. We saw that in 2022 when the Fed was tightening, not to the same extent. In the last couple of years, the degree of the low level of correlation among stocks is really a thing. I've never seen anything like it. It's almost like we talked about the stock market and the bond market diversifying each other, right? The stock market diversifies itself, which I think is really interesting. So the correlation between NVIDIA and Apple and Microsoft, it's really low. It was about a year ago, actually. It was Feb of 2024. NVIDIA reported a blowout earnings. Stock went up 16% in one day. Apple and Microsoft were barely up 1%. Last summer, Apple reported that it was in the AI game. The stock went up 7% in one day. NVIDIA went down. So these stocks are not moving together. And so let's just think about what that means for the index of the S&P. If I think about the volatility of the index, which again, it's very important because that volatility determines how much I could make or lose on a daily basis, and that's how people size their portfolios. Now, maybe some will just be like, I tuck it away, I never look at it, that's great, but a lot of people are reacting to this volatility. So the volatility of the index is a function of the volatility of the stocks, 500 of them in the index, weighted, so very, very much focused on the top 7, and then the correlation, right? So more volatile stocks and more correlated equals much more volatile index. We have stocks that are volatile. NVIDIA is it's a volatile stock.
Sure.
You have Broadcom is recently in the $1 trillion category. It's a very volatile stock. Tesla, 50% realized volatility, but they're not correlated. And so to me, the risk hiding in plain sight is that we've forgotten that correlation, which, as you shown on the screen here, was 12 for 2024. It's not just a record. It's not even close. We've never seen anything like this before. In the old days, during benign markets, that correlation was 35 or 40. And that's during benign markets. So I think it's a risk that we're just forgetting. And what I say to everybody is the very same conditions, whether it's a monetary policy uncertainty or a geopolitical flare-up, DeepSeek, that make stocks more volatile also tend to make them more correlated at the same time. And that's what's going to really jack up volatility at the index level, probably to the downside. Right. Volatility to the upside, but stocks to the downside.
Right.
And again, this is what leads me to think, to argue that folks really should take a hard look at their portfolio. Hopefully there's good gains in there. And just to think about insurance, not overinsure, because that's a thing. You could definitely overinsure, but just try to learn a little bit about how listed options work, and think about just doing some simple insurance strategies.
I think that's great advice. I mean, with correlation this low, one thing that we've learned in our years in the market, so when there is a real catastrophe, the correlations practically go to 1. Everything's collapsing.
Yes.
And then the portfolio you've been watching, and it's up 2%, 1%, 2%. All of a sudden, it's going to be 8% in a day, and 8% the next day. So at this point, it seems like it's a good idea to think about the insurance. Maybe underinsure, but have something on. So when all hell is breaking loose, there'll be something that you can hang your hat on. Or if you feel really brave, you can actually sell it and have that cash to make investments, which in general, after a crisis, there's a lot of opportunity.
Yeah. The last thing I would just say is, no one says to you, buy a tiny bit of life insurance just to try it out. What I would say with market insurance, try out a tiny trade just to see how it works. Don't spend any considerable amount of money. But what I've seen is folks go from never used put options to how many millions of them can I buy, because everybody's trying to buy them at the same time, and that of course makes it really expensive. So sort of have some shadow portfolio, very, very small, that you can watch just to get comfortable with it.
That's great advice. Well, Dean, thank you so much.
Thank you. It's awesome.
Appreciate you being here. Hope to have you back again soon.
Thank you.
That'll do it for Global Money Talk. Thank you so much for being with us today.